welcome all to part one of a two-part series on introduction to retrofitting for U.S. and global tax reform. So speaking today to myself, Bruce Stelzner, Tom Zolo, National Tax, and Kees Van Meel leads our international tax team based out of New York. As indicated, this is the part one objectives, which is to identify the drivers in U.S. tax reform, how they impact our structures and the legacy structures that we have and how they need to be retrofitted, EU tax reform, specifically ATAD 1 and 2, how that impacts U.S. multinationals, and lastly, the multilateral instrument treaty and how that impacts our structures. We'll hit Pillar 1 and 2, as well as MDR and DEMPI and SIGA. So here, drivers of change, why now? And we'll illustrate this in more detail in the subsequent page. But BEPS action items 1 through 15 in the BEPS report, BEPS 1.0 as people refer to it, really drove a lot of the change. And frankly, a lot of the changes based upon some perhaps gaps in the base erosion profit shift report that came out in 2015. A lot of activity that we'll see in the subsequent slide that's really impacting what companies have to address and how quickly it needs to be addressed. Clearly, we have U.S. tax reform has inverted how we address planning. We went from a deferral system to a worldwide min system. As Tom will discuss, there are a lot of pieces in the BEPS action item that was part of the tax reform, namely BEAT and 267 Cap A, anti-hybrid, interest limitations. All of these bits were addressed in the BEPS 2015 report. Case will hit in more detail ATAD 1 and 2, which was really an acceleration of the BEPS report and the EU trying to lead that process and has caused companies to really change how they're structuring in the EU. Then as well, we have SIGA and core income generating activities that came about simply because some of the structures were not captured by ATAD 2. Income shifts to a zero tax jurisdiction weren't necessarily challenged by ATAD 1 and 2, so there were more restrictions placed on haven entities. Multilateral treaty instruments and their ratification and the insertion of the principal purpose tax test has really caused a lot of tension on multi-holding company and tiered structures and whether they have the appropriate substance. And then as well, Case will talk about the mandatory disclosure rules. Everything we do in the EU needs to be reported. We have other jurisdictions that are now implementing MDR type rules that we have to address. We have DEMPI that is a part in the fabric of everything we do now. It has to have substance and the right functions. Tom will hit that more in the second part of this introductory session. And then we've got BEPS 2.0, just to make sure we weren't moving fast enough. Let's move on to our next global tax systems. There's just a tremendous amount of pace that's occurring and companies are having difficulty keeping up with it. There's some general theories and themes these reforms have been based around, whether it be in the US or overseas. The mismatch of income and deductions, the ability to have a deduction with no income or a double deduction with one level of income, the base eroding those profits through mismatching type transactions. That really has been addressed through U.S. tax reform and our anti-hybrid provisions, ATAD 1 and 2 and their anti-hybrid provisions, and the multilateral instruments and hybrid mismatches. The other piece that is a key focus and obviously was brought up in the BEPS report back in 2015 was transfer pricing and base erosion, shifting profits from high to low tax jurisdictions. That from a U.S. perspective, we have GILTI. From a foreign perspective, eventually we'll probably have Pillar 2. We've also eliminated base erosion through the application of the alternative tax system with BEAT. And overseas, we have DEMPI and SIGA, and again, ATAD 1 and 2 that are addressing base erosion and hybrid mismatches. And lastly, you just have local jurisdictional challenges in taxation and nexus taxation. So key drivers there really is the MLI, which has redefined how PE should be assessed. And one of the niceties that Tom will discuss here is that the U.S. is not a party to the MLI, so we still rely on our safe harbor provisions between our traditional tax treaties. And then again, Pillar 1 and 2, especially Pillar 1, will address allocating more profits to local taxing jurisdictions. So the first driver we'll hit today is U.S. tax reform. Tom's going to take us through this section.
Let's start with an overview of the old U.S. international tax framework. And I think it's important to point out this system largely came in with the 1962 Act. So it was the structure that multinationals were dealing with for over half a century. And during that century, the economy became much more global. International trade became much more significant for U.S.-based companies. But the old framework was really based on a dichotomy. That is, U.S. persons, so including U.S. corporations and corporate groups, were taxed on their worldwide income. And most recently, that income tax rate was 35%, which, although it was a relatively low corporate tax rate when it first came into the law, by the time of tax reform was one of, if not the highest corporate tax rate among developed countries. On the other hand, foreign earnings that were earned through controlled foreign corporations were generally not subject to U.S. tax unless those earnings consisted of passive or mobile sorts of income, subpart F income. In that case, they were subject to the same immediate taxation at the 35% rate. But for the most part, the active earnings of foreign subsidiaries were deferred and not subject to any U.S. tax until they were repatriated as dividends. And in that case, unless they came out of previously taxed income as subpart F income or an investment in U.S. property, they were fully taxable, subject to a foreign tax credit. And, because many foreign rates were much lower than the 35%, this provided an incentive for U.S. companies to keep their earnings offshore as long as possible. That was a so-called lockout effect. And one of the most significant pressures that caused tax reform was to eliminate this dichotomy on how income was taxed globally. Okay, so what is the new international tax structure? When you look at this slide, you can see that there are many new provisions that made the world, in a sense, more complicated, but they were meant to address the dichotomy. So the first thing that the Act did was to largely eliminate the indefinite deferral of foreign earnings. Now, the most beneficial aspect of the Act, if you just start at 12 o'clock on the structure, is the headline corporate rate came down from 35% to 21%. So a significant reduction. Moving to the right, there was a special rate that was achieved via a deduction for foreign derived intangible income, which largely is income from sales, licenses, services that are rendered to people outside the United States. On the other hand, the active income of controlled foreign corporations no longer qualified for indefinite deferral. Instead, under the new GILTI regime, that income generally gets taxed at a 10.5% rate, so half of the headline rate. In addition to that, a foreign tax credit is provided, but that foreign tax credit is subject to two very important limitations. First, the taxes that are associated with the GILTI are haircut by 20%, so only an 80% foreign tax credit is permitted. And second, unlike the old system where all the foreign tax credits were eligible for a 10-year carry forward, there is no carry forward of foreign taxes imposed with respect to GILTI. So, a very significant limitation. Now, there are limited exceptions from this immediate taxation regime. One is for high taxed income. Now, under subpart F, which remains a feature of the revised system, but the rate coming down to the new headline rate of 21%, there is still a high tax exception, so that earnings that are taxed at 90% or more of the U.S. rate via taxpayer election can be excluded from subpart F income and are exempt when those earnings are brought back as dividends. Similarly, there's a proposed regulation that would extend that to a GILTI high tax exception, where you could similarly have relief. The other big exception is that an amount equal to 10% on a CFC's qualified business asset investment essentially an investment in assets that are used by the CFC in generating tested income that is recognized as guilty, gets exempted off the top. Branch income under the old regime is taxed immediately to the U.S. taxpayer at the normal rates, but now is part of a separate basket. One aspect, very important aspect of tax reform, is to create additional baskets of foreign earnings that have a separate foreign tax credit limitation applied to them. The branch basket, unlike the guilty basket, does benefit from a 10-year carry forward. And then we have some additional restrictions. There are restrictions on various deductions. The most important is a increase in the Section 163J limitation on deductible interest. And then finally, there's an alternative tax, the base erosion anti-abuse tax, that applies where a U.S. multinational makes significant deductible payments to foreign-related persons. And as a result of that, its base erosion anti-abuse tax liability exceeds its normal tax liability. In those cases, the U.S. taxpayer has to pay an additional tax based on the BEAT. Okay, so where does that take us? First of all, the foreign tax credit has clearly become the primary mechanism to address foreign taxation. Now, there are a number of reasons for that. First, the lower U.S. tax rate results in there being a higher likelihood of excess foreign taxes as foreign rates come closer to, or in some cases exceed, the U.S. rate that would otherwise apply to that income. Also, the fact that we have multiple baskets results in more complexity in foreign tax credit planning, particularly when you consider that the guilty basket has no carry back or carry forward to it. And then finally, you have mismatches between when the U.S. rules require a recognition of income and when income is recognized for foreign purposes, or when taxes are considered paid for foreign purposes. So in computing the tested income that gets recognized by U.S. multinationals as guilty, you're applying U.S. tax concepts and timing rules, whereas for foreign purposes, of course, you're applying the local rules. Those alone might lead to a mismatch. But moreover, because many CFCs have a 1 month difference in the end of their taxable year versus the parent's taxable year, for example, a calendar year taxpayer may have November 30th CFCs whose local tax year ends on December 31st. The taxes that are associated with the earnings that are accrued, in my example, from January to November, may not actually accrue and be paid until the following tax year, December 31st, from a U.S. perspective. And therefore, that pushes the taxes that are associated with the first 11 months earnings into another year. And that can result in a mismatch. So any increase in uncreditable taxes could lead to a permanent difference. And certainly that's the case when you're excess credit in the guilty basket. Now, Minute Case is going to take over and talk a little bit about BEPS and ATAD and limits on hybrid structures. But the slide here says that in light of BEPS and ATAD, offshore cross-border financing and IP planning may become less attractive. That means that there has to be a greater focus on in-country planning in each of the places that a multinational group does business. And that focus has to be both on the direct income taxes and also withholding taxes. So we have to think about the application of treaties, which, as we'll discuss a little bit later, the BEPS project has also made a little bit more difficult. Okay, with that case, do you want to talk about ATAD 1 and 2 and EU tax reform?
Yeah, thank you, Tom. So talking about EU anti-tax avoidance rules, we mentioned already BEPS, the OECD, is looking at tax avoidance type of structures. And parallel to that, the EU has done the same. And where initially the OECD was just writing reports and making suggestions, the EU has at a record-breaking pace introduced anti-abuse rules, and this is really unprecedented. If you look at the timeline here, who would 10 years ago have predicted that this would all happen in such a short time period? And it's really unprecedented. And again, this is the reason why a lot of companies are now in a situation that they really have to retrofit their structure. So a little bit more detail on ATAT. ATAT 1 has a number of items. One of them is a limitation of interest deduction, very much akin to 163J. Further exit taxation. Some countries would allow you to take assets out of the country without taxation. That is terminated. CFC rules have been introduced. The GAR is typically sort of a catch-all provision where if you are not caught by any of the other provisions of ATAT, then GAR requires you to make an adjustment. And hybrid mismatch is typically something of ATAT 2. Anything hybrid is basically in the focus of ATAT 2. And in the middle, you see the items that are covered: hybrid entity mismatches, financial instruments, imported mismatches, PE mismatches, reverse hybrids, and tax residency. And in the coming slides, we will talk about a couple of those examples. So typically what applies to disregarded entity and what is ATAT aimed at? ATAT is aimed at situation where you on one hand have a deduction without an inclusion, or on the other hand you have a double deduction. And as mentioned here, the escape is dual included income, but that's something we will go into more detail about in part 2 of this series. So there is some unanticipated and unintended drawback of ATAT 2, and there's a certain overkill, and it has to do with some elections that are made in the US, and Bruce will briefly touch on that.
There were companies that had checked entity structures directly held by U.S. parents prior to the implementation of ATAT 2, and U.S. tax reform. But with U.S. tax reform, a lot of U.S. principal companies that were paying cost-plus payments to their foreign subsidiaries, whether on a contract manufacturing basis or R&D services or a lot of other type scenarios, it brought these individuals directly in the line of sight for ATAT 2 when they checked the box to treat these entities as disregarded for U.S. tax purposes. It eliminated the BEAT issue because now we have an intercompany transaction, but it put them squarely in front of ATAT 2 because from a local jurisdictional perspective, they have a deduction, they have a reimbursement on a cost-plus basis that's disregarded for U.S. tax purposes. So we have a deduction in local jurisdiction, and then because it's a DRE, that expense rolls up into the U.S., so we have a deduction for U.S. tax purposes too. So we have a double deduction, no income, squarely in ATAT 2. So now we have to address how do we mitigate this structure. The obvious is we can only make it a CTB election once every 60 months or 5 years. You ink your DRE, suddenly you're back into BEAT. Biden raises the rate, maybe BEAT is less of an issue. We also have the potential for DCL rules to kick in that frankly are quite nasty because they prevent the domestic use election. And if the local jurisdiction has mirror legislation under the DCL rules, you could have the expense hung up for both U.S. and foreign country tax purposes. Again, if we ink our DRE, apart from the issues we discussed, plus DCL, you may have an outbound transfer of IP. The old trade or business exception in 367A is not there. So we have issues with just inking an active trade with not significant intangible value. We have rebasketing issues, then as well to the extent there's any intra-company debt sitting out there. When you ink the DRE, you're going to have under 351B springing boot because your disregarded debt will become regarded, and now we have boot.
Yeah, exactly, Bruce. So a number of structures that no longer work under ATAT 2. This is one that has been implemented by a lot of U.S. multinational in some form, and this is the CVBV, but you can do it with Scottish partnerships, with Luxembourg partnerships. The idea is you have a reverse hybrid CV and you put value in it. It can be cash, it can be IP. You make that value available to the companies underneath, which you check as transparent from a U.S. perspective. And the Dutch company underneath here acts as a conduit. It is a back-to-back licensing company, or it is a back-to-back finance company. It receives interest or royalties from its affiliates underneath, and it all pays interest or royalties to the CV. In the Netherlands, you have a small spread. In the local country, you have a deduction, and in the CV, it is not taxed because the CV is not resident anywhere. That has come to a grinding halt. As of January 1st last year, that's when ATAD 2 became applicable, the royalty and interest payments by the Dutch company are no longer subject to deduction because of the fact that it's a hybrid, because there's a deduction on inclusion. On top of that, as of 2022, the CV will become a taxpayer if situations like this still exist. Another example is Luxembourg preferred equity certificates, or PECs or CPECs. Basically, that's a hybrid instrument. From a US perspective, it's equity. From a Luxembourg perspective, it's a loan. Same thing as with the CVBV. The Luxembourg company provides loans to its affiliate underneath. It gets interest income, and it is allowed a deduction against Luxembourg taxable profit for a deemed interest payment on the hybrid instrument to the US. Also, this has come to a grinding halt as of this January 1st last year. Finally, and this is what Bruce talked about, this is the unexpected, unpleasant surprise that we see a lot nowadays. We have a US parent that has a EU subsidiary. Subsidiaries checked as transparent. It makes widgets for the US parent and gets a cost plus from the US parent, and the products are shipped to the US. In this situation, the cost plus payment is only reported at sub-level and not at US level. We are in ATAD 2 because, remember, the expenses are dual deductible. They're deductible both as a subsidiary level as well as in the US. So we are squarely within ATAD 2. And absent a solution, the subsidiary that has a commercial profit of 5 will have a taxable profit of 105 because the deduction of the expenses is disregarded. And that brings us to the multilateral instrument.
The multilateral instrument was a way to implement some of the actions of BEPS 1.0. Now, you may recall that BEPS 1.0 had 15 different action items. The last of those was the multilateral instrument. And essentially, that was a way to take into account those portions of the BEPS 1.0 recommendations that would have affected the interaction between companies typically covered by treaties. And the four most important are listed here: hybrid mismatches, which both involve local country law but also treaty application; treaty abuse, so when should one country grant benefits of a treaty to a resident of another country; the anti-avoidance of the permanent establishment article, which was viewed by many as being too narrow under the old OECD standard treaty in allowing foreign enterprises to avoid having a local PE; and then finally, improving dispute resolution. Now, if these changes that would affect the interaction between two different countries were actually implemented through bilateral treaty negotiations, it would have taken years or decades or perhaps forever to get them through. And that's because if you consider that countries like the United States or the Netherlands have roughly 60 treaties, and then you multiply that by 60, you could see there were over 4,000 treaties in effect. And so the notion of the multilateral instrument was to provide a way that countries that agreed to implement the recommendations of BEPS 1.0 could very easily match up with one another and override their treaty. So the MLI doesn't actually amend treaties. It rather sits beside a treaty, and where the two parties to a treaty have agreed to adopt a provision of the MLI, it overrides the treaty. Essentially, it takes precedence over the treaty. And one important point to note on this is the United States itself has not adopted the MLI. And that may cause you to question, well, why is this important to me? And of course, it's important because multinational groups are going to have transactions between two or more foreign subsidiaries, and those treaties may have been amended. So this chart here simply illustrates how the multilateral instrument may apply to the four areas that I discussed. Again, the most important is the one at the upper right-hand corner, the avoidance of PE status. It was thought by many participants in this project that the existing exemptions for preparatory and auxiliary activities was too generous, and therefore there were recommendations to narrow the scope of what qualified for that exemption. Also, the thought was that the dependent agent portion of the PE standard was too narrow, and so the language was changed to pick up commissionaires and certain other undisclosed agents. And then finally, the idea that a group of enterprises ought to be brought together so that a multinational group couldn't, by fragmenting the activities that occurred in a country among various group members, could assert that no one of them separately had a permanent establishment, and therefore they all avoided the permanent establishment. The other really important piece of this is preventing treaty abuse. We know that U.S. treaties have very detailed limitation on benefits articles, and there was discussion about whether that ought to be adopted by countries, and it's certainly one of the options, but most countries have not opted to that. Instead, most that have gone into the multilateral instrument have decided to apply a principal purpose test, under which treaty benefits could be denied if a principal purpose of using an entity was to gain the benefits of a treaty. This slide simply lays out the signatories as of last November to the multilateral instrument. Again, you can see the United States in the light blue is not a signatory, and there has been far less than universal adoption when you look at this. The other point to raise is that for those that have adopted the MLI in some form, it doesn't mean that they've all adopted it the same way. So, this was a menu sort of option where the countries going into it could elect either to apply one of the provisions or not. And for some, like the PE changes, there were actually multiple choices that could be made. And so a treaty between two countries is overridden only to the extent that they have elected to make the same changes to their treaties. So what that has resulted in is, instead of having one model treaty, the OECD treaty, that, with few exceptions, is generally adopted in the 4,000 or so treaties, you now have a multiplicity of different provisions that may apply between two countries, and therefore it makes treaty analysis much more difficult.
Deck 6 and mandatory disclosure. Basically, this is the next phase after BEPS and ATAT, and where the latter are challenging aggressive tax planning, MDR requires real-time reporting of tax planning, so the revenue is a step ahead there. Now, note that disclosure of tax planning is something that is an item of interest on a worldwide scale. Apart from the EU, more countries are now introducing similar rules. Recently, Mexico and Argentina also introduced mandatory disclosure rules. On the mandatory disclosure, taxpayers must disclose, and under circumstances even before they have implemented tax planning. Mandatory disclosure is aimed at potentially aggressive structure, but a very wide net is cast, as we will see later. And that makes it extra important to timely and completely report, since there may be significant non-compliance penalties, and they apply for every failure to report. Also, mandatory reporting enables revenues to exchange information. What needs to be reported? Cross-border arrangements that meet one of the many hallmarks. And cross-border arrangements can be between EU member states or between an EU member state and a third country. And typically all taxes are in the scope of the MDR, with some exceptions such as VAT, customs, and excise duty. Now, in the next slide, we will see who has to report. And as you see here, two persons are relevant in the MDR rules: the intermediary and the relevant taxpayer. And for our purposes, the intermediary is the advisor and the relevant taxpayer is the client. And the primary reporting obligation is for the intermediary. So initially, the advisor in the EU has to report, but he can be excluded if he has a legal professional privilege. So if the intermediary doesn't have to report, the obligation to report is with the taxpayer. And apart from that, there can also be a situation where there are several intermediaries involved or several taxpayers involved. And in that case, there are separate reasons that are separate rules that are set out on the slide. And at the end of the day, you always have to report. The slide here shows the timeline for the mandatory disclosure reporting. As you can see, arrangement entered into after June 25, 2018 are in scope. And the retroactive reporting for the period from June 25, 2018 till January 1st this year is due coming February 28. Initially, this retroactive reporting was scheduled for August 31st, 2020, but then Corona happened and it was moved back for most of the EU countries. And we just finished the first 30-day reporting deadline for arrangements enter into on January 1st. So we are now in full swing. Other interesting thing, April 30 is the date for the first reporting of marketable arrangement. And a marketable arrangement is a cross-border arrangement that is designed, marketed, ready for implementation, or made available for implementation without a need to be substantially customized. Finally, the next slide will show you some arrangements that are covered by the MDR rules, and the ones on top, as you will see, may be less obvious, and the ones at the bottom are more obvious, payment to a tax haven and what have you, but who would think that providing a company car or do a cash pooling, that would be something reportable. And again, in case of doubt, the idea and the advice is do report, because at the end of the day, you want to avoid penalties. And that brings us to the New World Order.
Okay, thanks, Kees. And to this point, we have been discussing U.S.-based multinationals, but we also have some inbound planning that we'll discuss in a minute. When you look at the traditional structures for U.S. multinationals, they were characterized by a lot of holding companies when you look at this chart. And there was a reason for that. I mean, first of all, under the old regime, as I mentioned earlier, when dividends were repatriated back to the United States, generally deferral was ended, and those dividends were subject to immediate tax, subject to a potential foreign tax credit. And because the foreign effective rate was often lower than the U.S. rate, it was undesirable to bring those earnings back and pay a residual tax. Well, one way around that was to have repatriations out of a holding company that were returns of basis rather than taxable dividends. And in order for that to be the case, because earnings and profits come out before basis, you needed to have a so-called clean holding company on top that had that the U.S. parent had tax basis in, but which itself did not have any earnings and profits. And so that entity could, for example, borrow and then distribute the proceeds of the borrowing when it still didn't have any earnings and profits, and that would come back as a return of basis. Underneath that, you frequently had other holding company structures that were designed to segregate high-tax CFCs from low-tax CFCs. The reason for that was depending upon the company's foreign tax credit position, they might choose to bring back dividends through the top-tier holding company, either by bringing them up from a high-tier CFC, which could be used if the group were in an excess limitation position, or from a low-tax chain if the group were in a excess credit position and it needed to have some more capacity to take those credits. Another aspect of the typical structure is that it was the use of IP or principal companies frequently located in low-tax jurisdictions, or using reverse hybrids like the old Dutch CVBV, Irish structures, Swiss structures, or Singapore structures, and the like. And also the use of finance companies that had arranged in favorable jurisdictions where you could get a low rate of tax, perhaps using hybrid strategies. Those structures now raise a number of issues for tax reform, both U.S. tax reform and international tax reform. First, old Section 902, which pooled the foreign taxes of the offshore entities, is now out of the code. And so, as I mentioned earlier, well, most of the earnings of CFCs is going to be tested income that gets recognized as guilty, that is just an immediate use it or lose it tax. So the old segregation of high tax and low tax CFCs under different holding company structures is no longer necessary. Also, because most of the earnings of foreign subsidiaries are taxed immediately, that creates previously taxed E&P, which increases the basis in the top tier holding company. And those amounts can be repatriated tax-free as return to the previously taxed earnings and profits. In addition, once a company has repatriated amount up to that basis, any additional distributions are likely to qualify for 100% dividends received deduction. So the sort of repatriation strategies that dictated the use of the clean foreign holding company are no longer particularly relevant. In addition, when you think about these holding company structures, you have to consider that the adoption, the multilateral instrument of new restrictions on granting treaty benefits, may call into question whether holding companies with little or no substance would be granted the benefits of treaties as you're moving earnings up through them. Now, the lower tier of this chart touches on many of the issues that we've been describing. So rules that require substance in holding company or finance companies, the so-called SIGA and DEMPI rules, have made it harder to implement these structures in low tax jurisdictions. The sorts of anti-hybrid rules that Case has discussed makes it harder to use not only the IP structures, but also many of the finance structures that have been used in the past. The adoption under BEPS 1.0 and ATAD of CFC rules in the EU, but in other countries as well, also make it less desirable to have tiered holding company structures, because as you move earnings up through that chain, you may be denied treaty benefits, or you may be subject to CFC rules that require immediate taxation, whether amounts are distributed or not. With respect to U.S. inbound investments, we'll just touch on this quickly. Largely a lot of the same issues arose on inbound investments as foreign investments, but with a few differences. First, it was very common when you had a U.S. subsidiary of a foreign multinational to try to reduce the taxable income in the U.S. as much as possible because of the high rate here. And largely that was accomplished by things like leveraging up the U.S. company as much as possible and draining earnings that way, or alternatively charging royalties or other service fees. Now, in order to implement that structure, the foreign group might use a finance company structure, which is shown on the right of this diagram. And in some cases, those finance companies might have, for example, a U.S. branch that would administer the loans. That U.S. branch, well, it might be a U.S. trade or business. Under U.S. domestic rules, it may not have effectively connected income. Now, it was undesirable to have any foreign subsidiaries under the United States, and that's depicted here on the left-hand side of this diagram, because the United States, instead of having an exemption system like many foreign countries, still taxed dividends as they came up through the United States and had a foreign tax credit system as well. Also, we had our Subpart F rules. So one common situation when a foreign parent acquired an existing U.S. group with non-U.S. subsidiaries was to make an investment directly down into the top tier foreign CFC and dilute the United States so that it no longer owned a more than 50% interest in the CFC, causing it no longer to be subject to the Subpart F rules and getting out from under that. It also might provide a way, particularly if preferred stock were used, to bring earnings directly up to the foreign parent and bypass the U.S. group. Well, there are a lot of issues with that, and probably the most important, which is not listed directly here, has to do with the base erosion anti-abuse tax. Certainly, as the 2017 Act was being talked about, one of the big motivators was to prevent foreign parents from reducing the U.S. tax base of the U.S. subs by charging interest, royalties, service fees and the like, and therefore reduce the U.S. tax base. And the BEAT certainly gets at that. But there are other limitations like Section 385 and the expanded 163J, which may make expenses non-deductible. With respect to finance companies with U.S. or other non-tax branches, changes to the treaty rules may prevent the claiming of treaty benefits where there are earnings that are going to non-taxed branches. And finally, with respect to turning the CFCs held by a U.S. company into non-CFCs by having the foreign parent, make an additional investment, the downward attribution rule of Section 958 B4 has, or the non-attribution has been repealed. So now, as long as the CFCs through attribution are considered majority held by U.S. persons, the entity continues to be a CFC. So in this case, because, for example, USP is deemed through attribution to own whatever the foreign parent owns, the CFCs under USP 1 continue to be CFCs under current law.
That was fabulous. That was absolutely fabulous. Both Tom and Case, thank you much. And again, we'll hit DEMPI and SIGA and Pillar 1 and 2, and then we'll drill down on the different subject matters.